All right, we got a few plans talking about our education. Now, we've got a 529 plan and a Coverdell plan. These are two different types of plans, and we will compare them. First, we're going to go through the 529 plan. Now, this is a tax advantaged savings plan, just like a retirement account, just like a Roth, just like an IRA, 401k. Those are referred to as tax advantaged. Why is that? Because you're paying a lot less taxes on it. Generally, you don't pay taxes on the gains generated through that, but we'll talk about that more in specifics. Tax advantage savings plan designed to help individuals save for future college costs. These plans are sponsored by states, state agencies, or educational institutions, and they're authorized by the IRC. So they're sponsored by these groups, but they're authorized by the IRC. So these groups have to run it by the IRS, make sure that they have an eligible, legitimate plan. We got two types. We got a prepaid tuition plan and a college saving plan. Now, the tax implications of this include, it's quite similar to a retirement account, very similar, except instead of withdrawing it when you're 59 and a half, you are going to use it for college expenses. Now we've got tax-free growth. Earnings in the 529 plan grow tax-free at the federal level and often at the state level too. This means that any interest, dividends, or capital gains, so maybe you're doing a little stock trading in that account, generated within the plan are not subject to taxes, allowing the account to grow more quickly than a taxable account. You have a normal investment account, you got to pay taxes on the dividends received every year, on the gains and losses of sales you make. But in this, nope, you could just go on your merry way, do all your trading, get some interest, get some dividends, and not worry about taxes. Tax-free withdrawals. Withdrawals from a 529 plan, these are going to be tax-free as long as they're used for qualified higher education expenses, such as tuition, fees, books, supplies, and room and board. Non-qualified withdrawals may be subject to income taxes and a 10% penalty on the earnings portion of the withdrawal, quite similar to, again, our retirement accounts. Diving through an example here for our 529 plans, we've got a parent that contributes $5,000 per year to the plan for their child for 18 years. Very generous parent. Make sure you thank your parents if they helped you out there. There's a nice little PSA with an average annual return of 6%. Now here's a comparison of how this specialized tax advantage plan impacted the growth versus a normal taxable account, or you could just have a normal taxable investment account that grows. And in both of these cases, we've got total contributions of $5,000 for 18 years. That's not where the differences arise. The differences arise in terms of taxes that will be paid. We've got a total of $90,000 of initial investment. The account value is the same after each of these. Now, this is a super simplified example. Obviously, if you've got a normal taxable account, you'll be taxed every year on the dividends, on any sales, on any capital gains, on any interest. So this is just ultra simplified. Essentially, we are growing it and we've got the same account value at the end of the time period. However, we're applying a flat 15% tax rate here. Now, again, obviously in the real world, you'd pay tax on it every year. It'd be varying rates depending on your marginal tax rate, but this is just a simplified example because this is not that important. Oh, do I have great examples for you when things are critically important? Now, for our 529 plan, it's simply you've got $151,000, $151,225. That is the value of your account you can use for college. Now, college is very expensive. Maybe that won't even be enough, but hey, that's up to you to decide what college you go to. Withdrawals for qualified education expenses. We've got $0 in taxes there. Now, what about for our taxable account? We see that we're essentially going to take the value of it minus the contribution amount. That's the gain, right? So we have $151,000 of value minus an initial contribution of $90,000 times the taxable rate, which is 15%. Just get that up here. Capital gains tax on earnings. That is going to give us taxes owed of $9,000 roughly. So we see that the account value after taxes is going to be about $9,000 in difference. Yeah, it's a pretty significant amount. It's also great to open up a plan. It kind of separates it out. It's kind of like a savings account. You can think about it like that. Now, in this example, the 529 plan offers significantly more value due to its tax-free growth and tax-free withdrawals for qualified education expenses. The tax savings were over $9,000 compared to a taxable account. And additionally, if the parent is eligible for state tax deductions or credits for their 529 plan contributions, their overall tax savings would be even greater. As mentioned a little bit previously, we have also a Coverdell education savings account, similar to a 529. Think of these in the same family. This is going to be a tax-advantaged investment account designed to help families save for qualified education expenses, including both K-12 and post-secondary education costs. So you see, whereas our 529 was just dealing with normal college, this has a wider range. These accounts are established under Section 530. You don't need to know that. What are the implications here? Well, we've got tax-free growth, similar to 529 plans. They grow tax-free, similar to retirement accounts. This means that interest, dividends, and capital gains generated within the account, these are not going to be subject to taxes, which allows the account to grow more quickly than a taxable account. Any tax-free withdrawals, as long as it's used for eligible expenses, you've got qualified expenses, tuition, fees, books, supplies, other eligible expenses. There's going to be no fees, no taxes, nothing like that. However, if you take a non-qualified withdrawal, you could pay tax on that and a 10% penalty, right? Just because your money's in this account doesn't mean it's locked in there forever. You can take it out, sure, but then you got to pay tax on it, and then you got to pay an extra 10% penalty on the earning. Contribution limits and eligibility. The maximum annual contribution limit is $2,000 per beneficiary, so not too high, but also we're not talking complete college level here. We got K to 12. Hopefully you're not spending too much money on your earlier years, but hey, everyone's different. Contributions can be made until the beneficiary turns 18. There are going to be income limits for the contributors with phase out adjusting annually. Here we've got an example, and I'm going to be honest with you, it is quite similar to what we saw previously. Let's run through this pretty quick. Let's assume a parent contributes $2,000 per year because that's the maximum amount. 15 years, average annual return of 6%. We've got the current year. The phase-outs begin at $95,000 for single filers and $190,000 for married filing jointly filers. Here's a comparison of how these two accounts are going to compare. Well, we've got the same total contribution amount for both situations. The account value is the same, again, for both situations. However, for our taxable account, we will be paying taxes on the gains there. Now, we end up with a taxable amount of about $3,000. So we see paying taxes about $3,000 there. Again, very similar situation to what we saw before. It's not like you're going to have to do any math with this. This is just a demonstration, an example of how this all works. If you were interested, and if this helps create a visualization, paint a picture in your mind of what we're talking about. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.